Welcome back to the deep dive. Today, we're looking at something pretty significant for potentially hundreds of thousands of Americans living overseas. It's this choice. Keep your U.S. citizenship or, well, formally give it up.
Right. Renounce it.
And based on what we've seen, this isn't just, paperwork or an emotional thing. It's framed as maybe the biggest financial and legal decision someone can make.
It really can be. Some sources even call U.S. citizenship a kind of depreciating asset for expats.
A depreciating asset. Wow. Okay, so our mission today, let's cut through that complexity.
Yeah.
We want to pull out the key financial and legal stuff from the sources on expatriation, things like worldwide income tax, estate tax.
Yeah, that big one, the exit tax.
Exactly, the
Right.
exit tax.
Yeah.
So maybe start with the basics. What's the core conflict here?
Sure. It really boils down to how the U.S. taxes versus, well, pretty much the rest of the world.
Okay.
The U.S. uses nationality-based taxation. That means if you're a U.S. citizen, you owe Uncle Sam tax on your income and assets from anywhere in the world. Doesn't matter where you live.
Ah, right. Unlike most other countries.
Exactly. Nearly everywhere else uses residence-based taxation. You pay taxes where you live. So in America and abroad, you're basically stuck between these two completely different systems.
And the sources we looked at suggest this isn't just annoying. It can be financially quite damaging.
Oh, absolutely. There's this quote from James Dale Davidson back in 97.
I remember that one.
Yeah, arguing the system could make foreign investments so costly an American might face taxes far higher than anyone else, potentially hitting like 200% or more on certain long-term foreign assets.
200%. That's staggering, even if it's historical context. Did the sources link that kind of thinking to today's rules?
It definitely highlights the, let's say, hostility the U.S. tax code can have towards foreign financial stuff. The specific rules changed, sure, but that core problem, it's still there.
Which is double taxation.
Double taxation, yeah. Or at least the constant threat and complexity of it. You mentioned tools like the FEIE, the Foreign Earned Income Exclusion.
Right, and foreign tax credits treaty.
Yes, those exist. But the sources are really clear. These things mitigate the problem. They soften the blow. They don't end it. You're still dealing with the compliance burden of two different tax authorities.
Okay, so let's say that burden or the actual financial hit just gets too much. Mitigation isn't cutting it anymore. What does actually renouncing look like legally?
It's a very specific, formal process. It's governed by Section 349A5 of the Immigration and Nationality Act.
So not casual.
Definitely not. It has to be voluntary. You have to do it in person before a U.S. diplomatic or consular officer, usually at an embassy or consulate abroad.
Okay.
And crucially, you must have the specific intention of giving up your U.S. nationality. They really probe that. It's a serious legal step, one-way street.
Let's talk about the immediate upside, financially speaking. What's the good news people are looking for when they do this?
The main good news, tax-wise, is the immediate end to U.S. worldwide income taxation. Poof, gone.
Okay.
You become a non-resident alien for U.S. tax purposes. From that moment on, you only owe U.S. tax on income from U.S. sources.
So all that hassle with foreign bank accounts, foreign pensions, income earned where you live.
It just vanishes. From a U.S. tax perspective, anyway.
Yeah.
Big compliance headache lifted.
But there's always a but, right? Especially with taxes. What's the downside? The bad news on the tax front.
Well, there are a couple of big ones. First, the U.S. estate tax.
Ah, right. It still applies to assets you own in the U.S.
Exactly. What they call U.S. citizen assets. Think U.S. real estate, maybe shares in U.S. companies, things like that.
Got it. Stuff located stateside.
And for a non-citizen, the exemption amount for that estate tax is tiny, historically like $60,000. Compare that to millions for a U.S. citizen.
Wow. Okay.
So if you renounce but still hold significant assets in the U.S., the estate tax hit later on can be, as the sources put it, extremely expensive.
Extremely expensive. Okay. So that's the financial trade-off. What about the non-financial side? Your actual rights, like entering the U.S.
That's the other major trade-off. Once you renounce, under U.S. immigration law, you're treated just like any other citizen of your other country, meaning you lose the automatic right to enter the U.S., live here, work here indefinitely.
You give up the obligations, but you also give up that fundamental right of citizenship, easy return.
Precisely. You need a visa or ESTA, just like anyone else from your country.
Okay. Now let's pivot to what seems like the biggest financial landmine in this whole process. The thing everyone tries to avoid, becoming a covered expatriate.
Yeah.
A CE.
Yes, the CE designation. That's the absolute key.
What happens if you were labeled a CE versus if you're not?
It's night and day. If you manage to not be a covered expatriate, you basically walk away clean from a tax exit penalty perspective. No Section 877A exit tax, no Section 2801 covered gift tax.
And if you are a CE,
then you're hit with both immediately.
Let's focus on that exit tax, Section 877A. What is it? How does it work?
It's designed to be painful. The law treats you as if you sold all your worldwide assets, everything, everywhere, for fair market value on the day before you renounce.
A deemed sale, even if you didn't actually sell anything.
Correct. A deemed sale. So any unrealized capital gains on your home abroad, your business, foreign retirement accounts, stocks, whatever, it all becomes taxable immediately as capital gains in the U.S.
And you have to pay that tax bill before you're truly out.
You have to settle that tax liability. It can be a massive, unexpected cash requirement.
Okay, that really clarifies the stakes. So how do you get tagged as a CE? What are the conditions? I understand you only need to hit one.
That's right. Just one is enough. There are three main tests.
Okay.
1, the net worth test. Your global net worth is more than $2 million USD on the date you renounce.
$2 million. Okay.
2, the tax compliance test. You can't certify under penalty of perjury that you've been fully compliant with all U.S. federal tax obligations for the 5 years before the year you renounce. Title 26 compliance specifically.
5 years of perfect compliance. Got it. And the third.
3, the average tax liability test. Your average annual net income tax liability over those previous 5 years is above a certain threshold. It's indexed for inflation, but currently around $206,000 per year.
That $2 million net worth test seems like one that could sneak up on people. Is it just about cash or?
It definitely surprises people. It's not just cash. It's the fair market value of all your assets worldwide. Your house abroad that you bought 30 years ago and has appreciated hugely. That counts. Retirement accounts count. Business interests count.
So someone who doesn't feel rich could easily cross it just from, say, living in a high cost of living area abroad for a long time.
Exactly. The sources warn about that specifically. Long-term expats need a very careful evaluation right before renunciation.
And that second test, the 5-year compliance one, we hear a lot about FBRs, the foreign bank account reports, FinCEN on 14. How does that fit into the Title 26 compliance needed here?
That's a really important distinction the research points out. The FBAR requirement actually comes from the Bank Secrecy Act, Section 5312.
Not the tax code.
Right. It's not technically part of Title 26, which is the Internal Revenue Code that governs the CE tax compliance test. So, strictly speaking, failing to file an FBAR isn't failing a Title 26 requirement.
But, I'm sensing a but again. Practically, does it matter?
Practically, yes, it matters hugely, because on your tax return, specifically Schedule B, there's a question asking if you had foreign accounts and if you were required to file FinCEN Form 114. If you check yes to that requirement, but you didn't file the FBAR, the IRS is almost certainly going to say you haven't truthfully certified your overall tax compliance, even if the FBAR itself isn't Title 26. It calls the integrity of your whole 5-year certification into question.
So technically separate, but practically linked. You really need all your ducks in a row.
Absolutely. Compliance has to be watertight.
If someone realizes they're getting dangerously close to one of these thresholds, especially that $2 million net worth, are there ways to plan before renouncing to avoid CE status?
Yes, planning is critical, but it needs time. You can't do it the day before. The main strategy is logically net worth reduction.
Oh.
Legally decreasing your assets or maybe increasing your liabilities, or both. This often involves things like making gifts.
Giving money away.
Right, utilizing the annual gift tax exclusion or the lifetime exemption. But crucially, those gifts generally need to be made to U.S. persons and well before the expatriation date to be effective for reducing net worth for the test. It gets complex fast.
Okay, so individual planning is possible, but you mentioned something earlier about sort of multi-generational strategy involving kids.
Yes. This is maybe one of the most powerful long-term planning points from the sources. It's about setting up your children, from birth if possible, to potentially avoid the CE trap altogether if they ever choose to renounce later.
How does that work?
It relies on an exception for certain dual citizens from birth. If a child is born a citizen of both the U.S. and another country.
Like the country where the family lives.
Exactly. And if they are a tax resident of that other country and they haven't spent too much time in the U.S. specifically, not meeting the substantial presence test for more than 10 of the last 15 years.
Okay, so they primarily live abroad.
Right. And of course, they still have to certify their own 5-year tax compliance when the time comes. If they meet all those conditions, they can renounce and are automatically exempt from being a covered expatriate. No net worth test, No average tax test for them.
Wow, that's a huge potential advantage planning for the next generation.
It really is. It makes the future decision much, much simpler for them.
Let's shift gears slightly. What about green card holders? People who aren't citizens but live or lived in the U.S. long term. Do these exit tax rules affect them?
They absolutely can. The rules apply to long-term residents, or LTRs, not just citizens.
And an LTR is?
Someone who has held a green card, been a lawful permanent resident for at least 8 out of the last 15 taxable years.
Okay, 8 of the last 15.
If you meet that definition, simply moving out of the U.S. and letting your green card expire does not automatically get you off the hook. You're treated like a citizen for exit tax purposes if you then formally terminate your residency. That deemed sale tax is still a major risk.
Good to know. Now, on the flip side, who are the Americans abroad least likely to even consider renouncing despite all this complexity?
That's generally the retiree profile we touched on earlier.
Okay.
Folks who worked most of their lives in the U.S., maybe built up Social Security, pensions, IRAs here, and are now living abroad on that U.S. source income.
Why are they less likely?
Because they often don't have significant foreign assets or foreign income that the U.S. tax system is hostile to, as the sources put it. Their income is already mostly U.S.-based, taxed by the U.S. anyway. The double taxation problem and the foreign compliance headaches are usually much smaller for them.
Makes sense. But even for that group, you mentioned a specific warning about Social Security.
Yes, this is critical. If Social Security is a big part of your retirement plan, you must understand exactly how those payments will be treated after you renounce.
Treated by whom? The U.S.? The new country?
Both. Will the U.S. withhold tax? At what rate? Does a tax treaty with your country of residence give that country the right to tax it instead? Or could you end up taxed by both? Getting clarity on this, often through treaty analysis, is absolutely essential.
And failing to do that could lead to
unexpected, potentially large tax bills that wreck the retirement budget. The sources suggest this Social Security question is often a major deterrent, enough to make retirees pause or stop the renunciation process entirely.
So we've covered a lot. The act itself, the worldwide tax issue, the huge financial hurdle of the covered expatriate test, planning strategies. The clear message seems to be this is incredibly complex and the stakes are really high.
Absolutely. Specific tailored advice from qualified legal and tax professionals is not just recommended, it's essential. This isn't DIY territory.
Right. And interestingly, the sources also touched on the emotional side, trying to reframe it.
They did. One source had a line suggesting, you aren't losing a sports car, you are gaining 2 doors. Another put it as, you will always be an American, you are just retiring from the forms.
Retiring from the forms. I like that. It captures the bureaucratic release people might be seeking. But let's end with that really provocative idea you mentioned at the start, tying it all together. This concept of U.S. citizenship as a commodity.
Yeah, the idea of it being a depreciating asset.
Explain that a bit more. How can citizenship depreciate?
The argument is that for a young person, maybe just starting out, few assets, perhaps living and working in the U.S., citizenship offers stability, a relatively predictable tax environment, high value.
Okay.
But as you get older, if you move abroad, accumulate assets outside the U.S., especially assets, the U.S. tax code doesn't like the compliance burden grows, the potential for double taxation increases, the risk of becoming a covered expatriate if you do leave goes up.
So the cost and complexity of holding on to it increase over time, especially relative to the benefits for someone living abroad.
Exactly. The older you get, the more foreign assets you have, the argument goes, the less valuable that U.S. citizenship becomes from a purely financial and logistical standpoint, because the cost of eventually renouncing just keeps getting higher every year you wait.
It really reframes the decision, doesn't it? Not just if you should renounce, but when the cost might finally outweigh the benefit.
That seems to be the core calculation many face.
A fascinating, complex topic. Thanks for breaking it down with us. We'll catch you next time on The Deep Dive.